Welcome to the Infinite Mindset podcast, the show where we explore the power of the infinite banking concept and how to take control of your financial future. I'm your host, Andy, along with Scott and frequent guest Jared. We're here to help you think bigger, build smarter, and create freedom on your own terms. Let's get started. Okay, welcome everyone to another episode of the Infinite Mindset podcast. We got Jared back, which is great. We got Scott here as well. It's almost like we planned this with the skid loader in the background. I like it. We're going to talk about loans today and why it's so advantageous. But before we get to that, we were just talking a little bit. It was a nice weekend. I wasn't really doing a whole lot. I feel like with the kids and stuff, we're always constantly running around. What'd you guys get up to? Anything new?
I didn't do a whole lot.
Well, I got to watch my Buffalo Bills get creamed.
This is where the Broncos
We
fan
won't talk about that or I'm going to start crying.
This is where the Broncos fan exits the
Yes.
chat.
That's where they leave. Oh, man. So sad. So sad.
They're all
It's funny the Broncos win, but we'll see what happens with Knicks being gone.
all good games this weekend. No complaints.
No
Some
doubt.
good football.
No doubt.
I think the only blowout was Seattle. Every other game was pretty much quality.
Yeah. Now I got
I'll just be
like I
back here
said, it was
crying
nice
in my
just-
Cheerios.
I got my NNI interview tomorrow. 1 o'clock? I have to look. It's either one or
Nice. Good
2,
luck.
one or the other. So that should be good. Kind of excited for that.
Do you know who's going to be
It
on
was
there?
David that sent the invite. So, and I don't think it had anything there. So in regards to
Okay.
other people.
We're all real chill.
So
Usually Carl
Yeah.
Linkett. That'll be good if you get to meet him. He's awesome. They're both great.
sweet.
Yeah, it's kind of cool seeing the people that wrote the stuff and put the name to the face
Oh,
and actually get to interact. And you see, they're normal people. They're just trying to get it out there, get the word
I did
out.
make contact with that other person that is like 3rd generation IBC user. So try and get with him sometime this week. He's off just got back from a ski trip or something. But yeah, kind of looking forward to having a discussion with him in regards to passing that generational wealth on.
That's awesome.
Cool. That'll be good. Yeah, we'll hear about your meeting on the next podcast and what that guy has to say as well.
Yeah.
All right, cool. So we'll get into it a little bit. There's a lot of confusion when it comes to loans. So we're going to take a deep dive into this, look at all aspects of, the policy loan considerations, and is it actually advantageous to take a policy loan versus doing other means of financing? But before we actually do dive into it too much, I do want to give credit to Ryan Griggs in the book that he put out, How to Buy Whole Life. He does a really nice job summarizing and explaining why it is advantageous. You'll see a lot of this information is taken from there, and then we kind of put our own spin on it as well.
Great guy.
All right. So first off, we'll start off with point 1 here. And so a big thing here is when it comes to loans is just appreciating the fact that we can deploy capital without actually liquidating it. And that is huge. You've probably seen it out there. The loan is really what gives us this tool and this feature with whole life in order to do it. And so anytime we leverage an asset, it can be through policy loans, it can be through a HELOC, it can be through a security-backed line of credit. We are accomplishing this. And what's going on is we're avoiding potential taxes and we're not interrupting the growth. And so these two things here are huge. And if you look at any of these policies, we kind of talk about the hockey stick, where you have a little bit of a dip when you're initially funding it, then you kind of get back to even, and then it just takes off. And that, the bigger part of the stick is that hockey stick. And that uninterrupted compound growth and accessing the policies in this manner through loans is what allows us to get that growth, especially in the long term.
Yeah, maybe just, setting us up, set the framework for what's ahead. And just as we talk about loans, we're talking about loaning from the cash value of a whole life product. So we're going to talk about bank loans, and we're going to compare all of those and how that all comes together. But that's, just to kind of set the framework for what's ahead.
Yeah, I love that. Cool. All right. So moving on to the next point, we'll set up just a few definitions because this really gets confused quite a bit. The difference between capital and money. And so money is just a medium of exchange. This could be in the US, we're familiar with it. You got your green paperbacks. It's immediate liquidity. But capital is a little bit different. It's a worth or a value. It's the money that would be received if the item was sold. And so loans allow us to keep our capital so that it grows uninterrupted. And so with life insurance, we have other means of accessing cash value as well, but unfortunately, they will interrupt the growth. And a lot of these examples are actually done in becoming your own banker. And the reason it's done is because Nelson was nervous that if you mention the term loan, it would scare the reader because they have these preconceived notions of what a loan is and what it means and the debt and the payments. And the examples I'm talking about here, really the big thing they do in the book are partial surrenders. But there's other things too, where you could do a change in dividend elections or RPUs. And so I want to stress that is not the way you should be doing it. You should be taking loans if you're accessing the cash value, but it's important to bring these things up so that people have a framework and they understand what's going on.
Yeah, great example there of what Nelson's doing in the book. I get questions often that says, if this is not how you would do IBC, why does he use that in the book? And, a pretty simple answer is he's just trying to isolate one specific factor so that it's understandable, so that it's something we can absorb and take in, maybe as someone that's new or newer to IBC. So great point there on how he sets up the different scenarios in the book.
Yeah. And if you look at it, if you remember, right in the beginning of the book, he mentions that this book is not meant for life insurance agents. It's meant for the layperson who's out there who's trying to grasp it. And so I think in some ways, I'm going to call it a disservice, but he sets the landscape such that he tries to show IBC with its back against the wall and still proves that it is still a better option than everything else that's out there. Because if he were to set up situations where maybe it was more advantageous, then people could pick it apart a lot easier. So I think he does a very nice job in setting it up in that light.
Agreed.
All right. So we've touched on this before, but it's always worth touching on because maybe somebody hasn't listened to the podcast before, or, they missed it. But the whole reason is why life insurance companies actually allow loans. And I'm not going to go into the deep dive that I did before, but simply put, they would rather have the owner take a loan than surrender the policy, because that doesn't do anything good for anybody. We've interrupted the growth. We don't have life insurance anymore. And from the company standpoint, they don't have access to that capital to invest and go make money. So it's a win-win when everybody keeps the cash value there and they don't actually liquidate it. The other side of this, though, from the life insurance company perspective, is this is actually the most safe way for them to actually invest their funds from the general account. Because if you think about it, as an owner, we've already paid our principal, and the company knows that they have that. So when they give an amount that we can actually take in the form of a loan, they know they've collected enough that even if we never did anything and we abused a policy, they've already been made whole. But in reality, what's typically going to happen is you're going to get one of three things. Either the person is going to pass away, so you will have the death benefit paid out minus the principal and any interest that's owed, or they will surrender the policy either because they neglected it or they choose to do that. And that's why you have the cash surrender value. So you'll have an amount that is paid minus the principal and any interest. Or the most likely in a lot of these is it'll just be a loan repayment where the person pays back the principal and interest. And we'll explain more how that works. But the important thing here is that the company 100% in any of these scenarios is going to be made whole. So that's why they don't have an issue with lending out the money like they do. All right. Some things we do have to talk about, just because I want to always go over the worst case scenario, even though the chances are very unlikely. It's important that everybody understands all aspects. So there is a chance that if you do abuse this, what I'm getting at here is you're stealing the peas, you're not making repayments, you could let a policy lapse, and then that could be a very bad thing for you. But we've mentioned this before. If you find yourself in a position where you are struggling and you've done everything right, but you just don't have any other outs, come to your practitioner as soon as possible. And there are many things that we can do to help you out to make sure we can salvage a policy, not put you in a bad position. But the longer you wait, the more our hands get tied. Like I said, it does rarely happen. If you reach out sooner, we'll be able to help you out. But ultimately, if you don't steal the piece, like I mentioned, and you're disciplined, you're going to be okay. If you're a person and you know your nature and you can't save, do not do this, because it's not going to make a bad problem better. It's kind of like, I don't know, for an example, when you have a bad marriage and somebody thinks, oh, I'm going to throw a kid into the mix because that's going to fix it. That's probably not going to do anything good to fix the marriage. Now you've got a bad marriage and a kid you've got to deal with as well. So that's kind of the mindset there. But ultimately, it starts at the beginning. So when, Jared or I and Scott soon to do the same, when we're talking to somebody and we take a look at your finances, pretty quickly, we're going to be able to tell, are you a saver? Are you able to beat Parkinson's law? Is this going to be something good for you? Or do we have other obstacles and variables that we need to get under control before we even start going down the road of writing a policy? So that's step one. Despite that, things can happen in your life and you still may find your back against the wall. But if you're a disciplined person, we'll be able to help you get through that time and get back on your feet. It will not be an issue.
Yeah, really well said. The other, just to kind of back up when you're talking about allowing a policy to lapse. I mean, remember when we set these up, these are 20, 30, sometimes 40 or more years of annual premium payments. Now there's a whole bunch of different structures now how you can set that up, whether monthly or quarterly or, a whole bunch of different options. But let's just say you've got 40 years worth of annual payments. A lot can change in 40 years. And that's why Andy's saying, I couldn't agree with him more. Make sure you're reaching out and talking with your practitioner when life happens and things change. Pick up the phone. Even if you're playing honest banker and you're not stealing the peas, there's always some ways to get creative on allowing these things to stay active. So we don't want your policy to lapse either.
Yeah, I think, it's a good point with us and through the NNI and what I've seen. I think something that does separate us from other or life insurance agents is we do care. We are reaching out. I think every client you have, you're to ask them, even if they're always not getting back to me, I'm at least reaching out and seeing how they're doing. Whereas I think for a lot of other just straight life insurance people, there's a lot of times where they make that sale and they're moving on to the next one. It's very difficult to try and get a hold of them. I know, Scott, you've mentioned that with a few policies you had with a previous carrier.
Yeah, the person that wrote them isn't even there anymore. So I don't never met the guy that, sends out the, yearly whatever email. So more or less looking for more sales stuff, but I don't know. Don't know him.
And the other thing, the other thing is too, I mean, I know, Jared, we've had talks, I've talked with my mentor as well. God forbid something does happen, right? Because, all of us are mortal. There is a plan in place so that even though policies will become orphaned, somebody will look after the clients that I have. So don't just think, it's a one-stop, point there where all of a sudden if something happens, that's it, like, oh, what now? This guy's gone.
That's right.
That is not the case.
Completely agree.
All right, let's look at conventional forms of credit versus a policy loan. So when you look at any kind of conventional loan, the collateral is uncertain. And what I mean by that is the value of the collateral may not cover the loan if there is some kind of default on it. So when you look at a lender, they have to take this into account. And so that's why there's so much hassle. They're doing their best to make sure that they're not going to get burned. So we've all done it. We've applied for a mortgage or a car loan or something else. The skid loader in the back there, I'm sure they were going and looking through records or whatever else. On the other side of this, you have credit cards, and they have a very high interest rate. Some of it could be considered predatory. I'm not going to get into all that. But if you look at it, they are definitely going to have a higher interest rate just based on the fact that they don't know if they're going to be made whole. And look at how many, credit defaults there are. Not to get political in it, I know Trump right now is talking about the 10% limit. But if you think that's just going to fix it, you're probably mistaken, because these companies are smart. They're going to figure out another way to recoup and make money and not have losses. So I always kind of laugh. We've talked about this. I'm not a big fan of when the government gets involved in these things. There can be things where these companies are being predatory, but I don't like these artificial limits that are put there, because usually, I don't know how yet, but there's going to be some kind of second or third order effect that we haven't accounted for. But I'm sure somebody pretty smart in this already knows how they're going to make money at these companies, even if this comes into force.
Goes back to never mind that they created the problem anyway. There's a book. There's a book for that.
Exactly. Right. Now, coming back to this, so with the policy loan, right, the collateral is guaranteed. And we mentioned this already. Previously, we were talking about it through the death benefit or the cash value. The company knows that they're going to get their money back no matter what. So because they know the future value of the life insurance policy, this changes certain things in their behavior and how they actually give us the loans. Because of this, the life insurance company is able to give us loans and not have us go through all the hassle that we're kind of dealing with when we do more conventional type stuff. So it's these guarantees and certainties that separate the policy loan from other types of credit. All right. So that's a big thing there. It's the known collateral. And that's the reason why we are able to get policy loans on such favorable terms. But now that we separate policy loans from the other types of lending, what does this really mean? So when you go to the company, right, you don't apply for a loan. It's not like you go, hey, can you guys give me the money? No, it's in the contract. It's an order. As Nelson used to say, you get the gophers out there, you make them give you the loan. They're working for you. This is not a request. And there's no restrictions. If you've ever gone to the bank and you're trying to do something, they may go, well, what's this loan for? They want to make sure that you're not just going to blow it. There's not going to be a credit score check. As well, it's not going to impact your credit score either. The life insurance agency does not report the policy loan activity to the credit agencies. I get this all the time. Hey, if I take this, I'm going to be applying for, a mortgage at some point. Is this going to be an issue? The answer is no, it's not. And Scott, he's mentioned this before. Privacy is a big one, right? In a world where everything is being monitored, this adds a layer of protection between what you're doing and what the public can find on you. And so because of this, actually, though, we're required to take certain training. I know, Jared, you've done this as well. There are people, some unsavory actors out there that will actually use these to launder money. And so we have to do our anti-money laundering, because they'll do some pretty sketchy stuff and then try and take the cash value and let the policy lapse because it's more advantageous for them to do that. So we can get in a lot of trouble. Obviously, we're looking for it. We don't allow that to happen. Anything you want to add there?
Yeah, maybe just that they don't expect us to be cops, but they do expect us to know when to throw the flag if we sniff that there's money laundering involved. And, that's kind of the basics of that. But that there's, you got to be aware of where this sits and whether or not it's a threat or not.
Exactly. Exactly. Something else that comes up too when we're looking at all this is the time required to apply for a loan. And so usually when people look at these loans, they just look at the nominal costs. But think about, when you're doing something, you got to put tax returns together. They want to get all your W-2s, any of your 1099s, your K-1s, whatever it is. It takes time. And usually there's some back and forth and questions. Oh, where did this, deposit come from? How come you were spending on this? There's a lot of time that you could be spent doing other stuff. And this is a very subjective one. But it's important to account for that because the ease with getting one of these loans, it's huge. The other big thing here too is even if you go through all that, the bank may not even lend you the money, right? If they can't understand what you're doing, you may not get the money. So if they can't understand it, you can't convince what you're doing. They may not have your same vision. You may go all through all this. And now you're looking at other options for the money, right? And this is why non-institutional lenders exist, whether I'm talking about venture capitalists, angel investors, hard money lenders, whoever it is. Usually the credit for the most innovative and creative projects or the riskiest are less likely to be approved or come with more scrutiny and interest. So that's another obstacle you may have to run through where when you have one of these cash value loans, you don't have any of that. You can spend it on whatever you want. And so you're thinking, well, hold on, maybe this isn't me. Maybe I don't fall into this category. I'm not doing all these risky things. Well, maybe you do want to start a business. Maybe you have some kind of medical treatment coming up. Maybe you want to take a vacation. You're going to have that. And it's going to be so much easier to do this. And you may not get that loan or may not want to go through all the hassle of doing it for one of these other endeavors. If you go back to part 4, equipment financing and becoming your own banker, Nelson shows you exactly how just doing the boring things in life, financing whatever you're going to finance, sets up a very nice passive income stream later on. So I want to talk about all these things because sometimes people have different ideas or visions for what they're going to do with their policy loans, and it will work for the full spectrum. Those people are just doing the vanilla stuff that they were going to finance anyway, to people that have other ideas out there that are very non-standard, that it's going to be very difficult to get financing through conventional means. All right, moving on to interest. Here we go. This is the big one. There is so much noise when it comes to this. So a couple things, and I know we've stressed this before in other podcasts, but I do want to put this out there again. You are not paying yourself interest, and there are no interest-free loans. You are not going to make money by just taking loans themselves. And with that, let's kind of set up how it actually works. Interest accrues daily, and it's payable once per year on the policy anniversary date. So if you want to do the actual calculation to figure out what it is, I'm going to put all this stuff there in the notes. Don't feel like you have to copy this down now. But if, let's say you have a $10,000 loan, if you want to figure out the interest you're paying daily on that, you just take 10,000 times 1 over 365, because it's just for one of 365 days, and you multiply that times your interest rate. In this case here, I'm going to use a nominal 5% interest rate. So I multiply times 0.05, and I'm going to get rounded 1.37. So $1.37 per day. However, this is really big. That $1.37 per day is only added once per year on the anniversary date. So even though it's there and it's building in the background, you're not going to start compounding that amount until you get to the anniversary date. And if you pay it off before the anniversary date, it's never going to compound. You're just going to pay that one-time interest, which is really big. So for this reason, if you do nothing else, we recommend at least paying the accrued interest for the year to avoid that interest from going to the principal and having that compound. And to kind of think about this conceptually, we always talk about the cash value and how that's going to build and how compounding makes it grow over time. Well, it works the same way. If you're stealing the peas and you're not at least paying the interest, that interest can definitely compound and get away from you. So you have to be disciplined. And this is why Nelson stresses the human behavior so much, and why we talked about before, if you're I wouldn't call it a bad actor, but if you have bad habits, this is not going to fix those bad habits. We need to fix that before you get involved with this. This is really cool, and this is huge. People don't realize it. It's a really good thing, but when you make a payment on your policy, a loan payment that is, 100% of that, 100% is going back to principal. You're reducing the dollar for dollar basis upon which future interest is accruing. So to sum this all up, to make sure everybody gets it, repayments go entirely to principal, and loan interest only compounds once per year. This does not exist anywhere else in the conventional lending world. This is a huge advantage towards taking loans through the life insurance company.
Yeah. To build on this, on the concept of, you're not paying yourself. Remember that if someone else is holding your money or your assets, they're going to pay you a dividend on that. But if you're holding someone else's money or someone else's assets, you're paying them interest on that. And this is the very same setup. Like, you're when the insurance company is holding your money, they're honoring a dividend year over year for you. And yet, if you're going to borrow from their general funds, they're charging you interest to do that. But the straight interest on how they do this is so simple and so brilliant in terms of every single dollar goes to principal that you pay. I really encourage you to if there's questions, to dive in the weeds and try to figure out which one makes more sense, because it's pretty clear.
Yeah, we're going to unpack this a little bit more in another couple sections, but if that doesn't make sense, just stand by. We're going to get there, and we'll show you why this is so important. Moving on to the next thing. Right. So structured versus unstructured. So we're looking at a structured loan. This is when you're thinking about a car payment or your mortgage payment or something like that. It's a fixed duration with a fixed payment schedule. And this is where on the repayment schedule, the lender is going to distribute interest charges to his advantage. And so we've seen this before. And, and contrary to what we just saw in that previous section we talked about, when you make a payment, you're not just paying principal, you're paying principal and interest. So you're not just paying that principal amount. So you've got a lot more compounding and a lot more growth on their side, which is why you're paying. And we'll talk about this in a little bit. The volume is so much higher on these other conventional financing methods. However, if we look at an unstructured loan, there's no specific repayment schedule. When we're talking about this, we're typically talking about a credit card, a HELOC, some kind of commercial line of credit, something like that. Now, in here, the interest compounds daily, just like we saw on the policy loan. However, it's added on a monthly, not an annual basis to the principal. And this is where that interest really runs away a lot more on these other conventional lines of credit. And so that more frequent compounding means more dollars going to interest versus principal reduction versus a policy loan. So it's really important to understand that. Anything else you guys want to add on that one?
Just that they're using these amortization schedules as well, right? Like they already know how much interest they're going to get from you when the day you sign the dotted line. And that's protecting their risk from what we've already said earlier, which was they don't know if your asset will cover the loan that they're providing you. So they're covering that risk through that method.
Exactly. And then Scott, you done this on the previous podcast we did where we looked at yeah, go ahead.
No, that's exactly what I was going to say is the volume of interest is all up front, and you get that interest back to you, and then you can use that to create more money. It's new money to your system, just keeps creating more, and then you get that snowball effect. It's why the bank has the nicest building in town. So.
Yep, that's exactly it. All right, so if you want to get the true interest cost, there are two parts. So first, you have to account for all the costs, not just what the APR is, that nominal fee that we're seeing. You have to look at the admin fees, the origination fees, the closing costs, something we hit on, the value of time and effort in securing and managing the loan, which is subjective. So that's going to be something that's going to be a little bit different for everyone, but also the cash difference. That's a big thing. So if I were to pay the full amount now in cash versus taking the loan from the company, or sometimes they'll drop the APR to make it look more enticing, but then they'll up the principal that you're going to owe. You have to account for all this stuff. And so this is where we were just touching on that volume versus the APR. So the example we'll look at here, let's say we have a low single digit APR. So we're looking like, pre-COVID when everything was going crazy, we're looking at a 30-year mortgage. And when you look at this, the volume of interest is typically a high double-digit percentage relative to the principal. So that pre-COVID amount I'm talking about, we'll take a $500,000 home. Let's say you're putting 20% down with a 3% APR. You're not going to find that right now. We'll do a 30-year term. If you assume you're financing $400,000 because you did the 20% down, you're going to end up paying $258,000 in interest over the 30-year course, assuming you stick to the schedule that they give you. So you're paying 65% interest on a 3% APR loan. And so that was, you look at that, that's astonishing. That's 65 cents of every dollar you borrow is being paid in interest. And so people make the argument, well, hold on a second, you have the time value of money. The borrower gets $400,000 now, but it goes both ways. The interest dollars, when eventually paid, could have been used to earn elsewhere. And so you have to look both sides of this. So the big thing here in this example is $258,000 is permanently leaving your personal finance system and not working for you anymore. So if you want to actually figure out the true cost, the true interest cost, and I'll put this formula in there as well, you're going to take your total quantity of dollars paid in interest divided by the principal amount and multiply that times 100%. But make sure when you do that total quantity of dollars, you're including all the stuff we talked about, all the fees, the origination costs, the time and everything else, and the management of that loan. So this covers everything for a structured loan. For an unstructured loan, the big difference is how often the compounding occurs, and we already touched on this. So We cover the structured for the unstructured here. The true interest on a conventional unstructured loan will always be higher when we're looking at the same interest rate. And the reason is because we're compounding monthly versus annually. So now that we understand how to get the true interest, we need to move on just a little bit further, because a lot of times people just look at the numbers, and we're slowly getting there. And I think this is going to make a lot more sense. If you got a mortgage APR that's 3% and a policy loan rate that's 5%, or an auto loan rate that's 2% and the policy loan is 5%, you go, well, hold on a second, look at the nominal number. It must be better to take the lowest interest. But you have to figure out the true interest cost, which you can do what we just talked about. And so to get an accurate comparison, we're going to go through a few different examples and kind of show you what I mean here. So these are 3 different examples. We're looking at a $10,000 loan, the nominal 6% interest rate. Well, in the first example, we're going to look at the money borrowed on the policy anniversary date and then repay the entire $10,000 on the following year anniversary date. And that's pretty simple. For doing 6%, it's $600. Most people can do that math pretty quickly. But if we do the same thing and we have $5,000 is paid halfway through and the remainder is paid at the 1-year anniversary date, now we drop to $450 in interest. Now we're only paying 4.5%. So we started with 6% is what we're seeing on the paper, but we only paid 4.5% when we look at the repayment. And then just one more example. It's going to be a little bit on the nose, but in this case, let's say you have a $10,000 loan, you pay it back early all at one time at the 10-month point, you'll pay about $500 in interest, or a true interest rate of about 5%. So what does all this mean? It's really important to understand the numbers and do an apples to apples comparison. You can't just look at a 5 and a 3 or a 5 and a 2. You actually have to understand that volume of what you're paying. And we talked about before, on the fixed side, there's interest and principal. With the policy loan, it's just principal. And then on the unstructured side, it has to do with how often it's being compounded.
Yeah, so important. You got to, sometimes rethink your thinking on looking outside of that conventional wisdom, on what we've known our entire life, on how we finance things from the bank. If you're taking that function over, learn the new way on how to make that effective.
Exactly. All right, here's one that comes up, and I think a lot of people struggle with this when they first get into the infinite banking concept. They feel like they're paying for the same thing twice. And so you're going, why would I pay premium, take a loan, and have to repay the loan? This makes no sense to me. And so 100% it can feel like that early on, because there is a startup cost. You are getting a business going. When you're looking at the first 5, 6, 7 years, it totally depends on how this thing is set up. Your annual cash value growth will be slightly less than what the total annual premium will be. And it's worse year one, and it continues to get better because it gets more and more efficient every year. But once you start seeing annual growth greater than the annual premium, it starts to become much clearer. And that's where people really start getting it. And you'll end up with more capital than you ever put in to finance the needs and wants of life. And so the truth is, you were never actually paying twice, though. You have 2 separate streams of money. One was a premium payment, and the other was a policy loan repayment, which are 2 distinct cash flows doing 2 very different things. And so to give you some kind of context to this, if you go back to Part 4, the equipment financing example, how could the logger pay twice for the logging equipment and have a steady stream of cash later in life that far exceeded what he paid into the policy if this thing wasn't efficient? And we already mentioned it before. He's not even doing it the most efficient way, because he was doing partial surrenders. Had he actually been taking loans and redoing the payments that way, it would have been far better off as well. And so this is something to think about. If the true interest of the financing through a policy loan requires less interest than conventional financing, won't this also free up more dollars for premium and the opportunity to start even more policies? So it's another way to even free up more capital or premium dollars to develop more capital, more cash value. And so really, if you want to sum this up and why people get confused on this, the conundrum and why people think that they're paying twice, it really comes down to short-term thinking. The longer one can project into the future, the easier it is to see the benefits of operating in the framework of IBC and seeing that exponential hockey stick that you see with the cash value and the capital that you have access to.
Yeah, really good point there on what that looks like with the short-term thinking. And, I definitely understand. I know I struggled with this paying twice kind of concept, but I think what helped me get past that, or at least think at it a different way, was that you've got to store your funds somewhere. So whether you're that person who takes debt and then pays everything back slowly and you still end up at zero, or whether you pay in cash and then now the value of that item goes down in over the course and you still end up at zero. This is the concept of that longer term thinking and the hockey stick, like Andy's referring to, of where are you saving, or where are you building your warehouse of wealth so that you can borrow from that, or you could just continually end up at zero. So I know that this was something I struggled with when I was looking at it first as well.
The other thing is too, and I was thinking about this now, Nelson points this out in the book when he does the apples to apples comparison with the CD versus the policy loan. And it's about year 14 or 15 is where the policy loan finally overtakes a CD. It takes a long time. And that's just the way this particular policy was structured. We can do it differently. But not only does it overtake the CD option, it exponentially overtakes it. So it's not like it just runs away a little bit. When you start going to year 20, 25, and 30, I mean, forget it. It just runs away. It's not even close. So it's that short-term thinking that gets most people in trouble. All right, when to use policy loans. So this comes up a lot. Becoming your own banker, we talk about large purchases, investments, but typically not everyday finances. I think people get confused here because there's a part in the book where they talk about putting all of your income stream through a policy. Really, the way that I think about that is eventually through the dividends and everything else, you're getting the equivalent of what your income would be, but you need to have some kind of daily stuff going on. There is an example that I've seen through Stearns, and he had one person that he knew that was actually doing this where they were almost monthly doing stuff, paying everything through policy loans and then repaying it. But it usually doesn't even work that way because most people are not disciplined, nor do they need to operate that way. So there are exceptions to every rule. That's why I bring it up, but it typically does not happen. I think something else that leads to the confusion here is that they think somehow, we touched on this before, that loans will somehow grow the cash value and the death benefit of a policy. Most of this comes, I think, from looking at the equipment financing example in part 4, because people don't really understand what's going on there. We do have another webinar where we covered it, but what's actually growing the cash value and the death benefit there is more PUA, more premium is actually going in. And as we just discussed before, premium is the only thing that will grow that cash value. Repaying loans. So it's really important to have a plan, right? We talked about the everyday expenses above. If you were to do something like that, you're constantly taking loans to pay for your everyday expenses and you have no way to pay it back. We talked about before, eventually when this thing is compounding annually and you're not paying anything, it's going to get away from you. So you always want to have a plan to make that payment back. But looking at this, it's really simple. Don't overcomplicate it. Just don't steal the peas. Depending on your understanding of what's going on in your personality, you may need to set up something that looks more like a structured payment. Maybe you're somebody who has a business like real estate and you have big influxes and outflows of cash going on. And so you don't want a structured payment, you want an unstructured, but you do have a plan to make a payment back. It really doesn't matter. You just have to know your personality and your payment and what's going on. Another thing, opportunity cost. Where do you actually want to deploy these funds when you're actually taking a loan? You can't just look at the rate of return. Let's say you have an opportunity to earn 10% on investment and the loan rate is 7%, but you need to commit the capital for a year. The big thing is here when we're talking about opportunity costs is if you've lost access to that capital for a year and you're going, well, hold on a second, I got a 3% delta there. And, we can look at true interest and what you're actually earning. That's really not the point. The thing is you have a positive delta here that's coming in, but you're losing access to the capital. So that opportunity cost is what we're getting at. Now, all of a sudden you may have a deal that's coming around where you have a 20% return on it, but you can't do anything about it because your capital is locked away for the year. So when you're looking at taking a loan or doing something, we're not telling you not to do anything or be paralyzed because you're going, oh my gosh, another deal might be coming along. We're just telling you to look at the full landscape and actually understand what committing capital does. And so the whole point here is don't get over eager. We've seen it before where sometimes people start building up capital and they have this constant need to deploy it. And once again, we've used this example before. Go back to the equipment financing example and becoming your own banker. It was really boring. He was financing things that he was going to finance anyway. You don't have to keep telling yourself that I need to invest and make more money. Do your due diligence. Don't rush it. And don't be the person that finally has an amazing opportunity, but they have no capital to seize it because they felt like they always had to put every last dollar to work.
Well said. That was a really hard concept for me to grasp. You're building up multi years when you're in it, and you're multiple years into your first policy maybe, and it's really productive. And you're like, wow, there's a great little bit of cash value that's sitting there. And you almost feel bad not doing something with it. And you have to just take that constant reminder of you're paying premiums alone is doing something. It's gaining within the policy. It's allowing me to have more liquidity and more options than I had ever thought possible. And so just having that alone is enough. That way, if it does come along and there's a great opportunity, you can pounce. But I have to check myself on that often. I'm making sure that I don't get this, I don't know, just analysis paralysis of the need to put it to work, right? It's working right now.
Well, yeah, I mean, if you look at the outside environment and everything else conventionally that we're taught to do, it's understandable why people feel that way, right? You feel like if it's just sitting there, you're losing out to inflation or something else, but realize the growth on these things is pretty decent. We're just telling you to do everything you've been doing, just finance it through this. You don't have to go out there and get too wild. If you're already doing wild stuff,
That's right.
great. But just because you have this doesn't mean you have to start down that journey, or down that road.
That's right.
All right.
That's right.
The last little part here, I look at page 69. This comes up quite a bit. People get confused sometimes with the interest and the stuff that's going on there. So I do want to point out that there are ways that you can write the interest off. We are not tax professionals. We are not wearing other hats telling you what to do. So obviously do your own due diligence here. But I will tell you from my own personal experience, there are ways to write off interest. The two that come up typically are either if it's business related or an investment purpose. I caution people on the business related side because typically they have to put the owner of the policy as the business, and that opens it up to a lot of scrutiny and you give up a lot of the privacy that comes with that. The way I personally do it is on the investment side. And as I take stuff out, there's different ways that you can annotate those dollars that are going to interest. But we talked about before, you have to understand exactly what it is. You have to have a calculator. You have to really keep up with it because if there is some kind of audit, you're opening yourself up to scrutiny. I'm not telling you not to do it, but just understand the risk that you're taking on when you do that. All right. Well, I'm going to wrap it up here. I've got another meeting coming up here in just a little bit. But Jared, anything else you want to add before we get going?
No, long episode there on policy loans. A lot of content to be had there, right? Like there's just I love the discussion had with us and the three of us on just the back and forth on there's three people in this room. There could be three different ways on how to look at a policy loan, right? And that's just a policy loan from the life insurance company. We're not talking about the outside stuff and how conventional wisdom has really tainted our view of loans to begin with. So I love that happens here and in this environment because it just shows how dynamic these can really be.
Yeah. And I have no doubt that questions will come up, or maybe you heard something and you're kind of wondering what's going on. So please don't hesitate, reach out. That's what we're here for. A big part of what we do is education. We want to make sure that people are very comfortable before they take that first step.
Totally agree.
All right. Well, thanks. Thanks for watching. And don't forget to tell your friends about this, and we hope to see you on the next episode.
Cheers. Have a good day.
Thanks for tuning into The Infinite Mindset. If you found today's conversation valuable, share it with someone who's ready to think differently about finances. And don't forget to subscribe. Your journey to financial freedom starts with the right mindset.